Okay, so you should have done these questions, and now I'm going to give you the answer. The answer should be pretty straightforward for the first question here. What is the profit margin? Profit margin is net income divided by sales. So I just take 175,000 divided by 2 million. Okay. Suppose that the next year sales increase by 10%, so my sales will be 2 million times 1.1. And the cost of goods sold increased by 20%, so my cost of goods sold would be 1.4 million times 1.2. Okay, I already did all of the calculation here, did a bunch of them. Okay, so I did all of the calculation here. I have 2,200,000. I have my new cost of goods sold, and then I think all of this is pretty straightforward. How I found the rest. Maybe the tax. Some people will be confused, but the tax does change. The other numbers didn't change because there's nothing in the question that indicates it should change. But the tax are 30% of EBT. Right, so the tax did change, and then we can find our net income. I can calculate the net income in the first year, which was 175,000 divided by 2 million. And I can calculate the net income in the second year, which is the net income here divided by my sale. Okay, and that gives me my profit margin. So the answer to the first question was 8.75%. The answer to the second question is 5.41%. Okay, that's the answer to this question here. Okay. The answer to this question now is actually pretty straightforward if you are able to work with these numbers without getting too confused and you understand DuPont analysis and DuPont decomposition. Okay, we know that the ROA is the profit margin times the asset turnover. Now I know in the textbook they call it total asset turnover, but you'll figure out now actually that there's multiple names for the same ratios often. So try to think about what the name means, right? So we know the ROA is the profit margin times the asset turnover. We know the ROA for global healthcare and for the industry, right? We could plug that in here. We also know the profit margin. What is the profit margin? The profit margin is the net income or the return divided by sales. So it's the return on sales. That's what I just said earlier, right? There's often multiple names for the same ratio. Profit margin and return on sales are exactly the same thing. Okay. Well, we know that global healthcare has an ROA at 18%, which is much higher than the industry, but they have a profit margin that is much lower than the industry. So how can they get such a high ROA if they have such a low return on sale? It means that their asset turnover must be much higher than the industry on average. In fact, we can calculate it, right? If this is 18%, right, we can divide by the profit margin on both sides. So I can divide by the profit margin on both sides. Whoops, keeps doing this. Okay, and we know that the asset turnover for global healthcare is 9%, not 9%, 9 times, sorry. Okay. For the industry, we would have the ROA, which is 12%, that we can divide by 10%. This is why I didn't finish writing it correctly, because I hoped it would save me. So we can do 12% divided by 10%, and that will give us the asset turnover for the industry. How is this company managing to have such a great return on asset despite having a low return on sales? Because it has a much higher asset turnover than the typical firm in the industry. Okay, that's the second question done. The third question is this company has an ROA of 12%. If its debt to total asset ratio is 40%, what is the ROE? A lot of students struggle with this one. It's actually really easy. I usually show two solutions, but I'll show only the easiest one because I've never noticed any students in the class or in the exam using the harder method of solving for this problem. So we know that the ROE is equals to the ROA times the equity multiplier, right? We already know the ROA is 12%. We don't know the EM, the equity multiplier, or do we? Right? Do we know it? Well, we know that the equity multiplier is equals to the assets divided by the equity, right? This is not given to us anywhere, but we do know that the debt to total asset ratio is 40%. The hard way of answering this question would be to use algebra to figure out what A over E is, right, given this debt to total asset ratio. And we should be able to do that because asset is equity plus debt. Okay, and so debt is going to show up, and we can try to solve for the equity. However, this is probably not the easiest way to solve it. Here's the trick I give my students all the time. Whenever you have a question like this one, just tell yourself, like, it doesn't matter here what the value of asset is. So let's assume asset is 100. Let's assume asset is 100. If asset was 100, what would equity be? Well, we know that 40% of asset is debt, so 60% of asset must be equity. So there should be $60 in equity, and we have that 1.67 is our equity multiplier. Using this information, we can easily calculate the ROE, which is equals to the ROA, 12%, times the equity multiplier, 1.67%. And if I am good at mental math, this is 20%. I'm not good at mental math. I just did it before showing you the answer, and that's why I know it. Okay, that's the answer for the first part of the question. The second part of the question just says, well, what would happen if we have no debt? If we have no debt, the equity multiplier would be 1, right? Asset would be equal to equity, so this A would become E, and we would have E over E, which gives us 1. So in this case, the ROE would be the ROA times 1, which is simply the ROA, 12%. And that's the answer for our questions. Okay. Here we have a slide for asset utilization ratio and when they should be high or lower. I don't know why it was here. I should have put it higher. Over here, and I already talked about it. I already explained all of this. We generally want higher turnover ratio except for the payable turnover, right? I don't know if I talked about that one, but a slowdown in turnover ratio usually highlights some problem. We have like a hard time moving our inventory, right? Or there's an increase in bad debt. I did explain that ratio shouldn't be too high either, right? Even if we want the ratio to be high, it's possible that our credit policy is bad, right? Or that we often have stockouts, and those are signs that we're not able to sell as much as we should. So we don't want super high asset utilization ratio either. Okay. There are more questions for you, starting with question 6 here, question 24 and question 21. So I'll let you do these ones, and then I'll come back to do the solution for you in a second. Okay, so you should have stopped it. I'm going to do the solution now. If you didn't stop it now. This Walker glove question is pretty straightforward. The first part, they ask us to find the net income and the return on asset. We know the sales and we know the profit margin. So the net income is actually pretty straightforward to find. We do the sales. We multiply it by the profit margin, and we get our net income. In order to find the return on assets, a little bit harder. They don't give us the asset. We just found the net income. Return on asset is net income divided by asset. So we need to find our asset somewhere. There's a pretty straightforward way to find it here. We know that the asset turnover, which is our sales divided by our assets, right, is equals to 3.4. Okay, we want to find the sales. So we want to find our sales, we want to find our assets. We have our sales, so we can replace the sales here by 1.25 million. Okay, and we can multiply by asset on both sides of this equation and divide by 3.4 on both sides of this equation, and we get that our assets are equal to this number here. I'll have to use Excel to calculate that. 1,250,000 divided by 3.4, 367, 647. 367, 467, 640, 647, 0.06. Okay, sorry for the little delay here. This is an ugly number. But now that we found assets, now that we found net income, I should actually calculate it. I'll do that when I go back to Excel here. But we can easily find our return on asset. Return on asset is equal to my net income, which is this number here, that I divide by my assets, which is this number here. Okay. Again, I keep doing the same mistake. Okay. And so I believe this is 100,000, but let me verify here. Yeah, that's 100,000. So it's 100,000 that I divide by my asset 367, 647.06. Okay, and I just put that in my calculator and I find my return on asset. Which is 27.2%. I don't know, maybe my decimal is not set correctly on Excel, and maybe we can get more decimals. In the exam, I always try to keep 2 decimals. I just don't think it's so important here. I just want to give you the general idea of what you need to do. Question 24, I'm going to do the solution. All of these are pretty straightforward. I don't think there's like much here for me to do except say the answers really quickly. Just go back and look at how we calculate this. Account receivable turnover is usually my credit sales, but here we don't know how much of it is credit sales. So we'll just take all of the sales, $4 million, and we divide this by our account receivable, 800,000, right? And that gives us our account receivable turnover. In order to find our inventory turnover, again, we take our sales, 4 million, that we divide by our inventories, 400,000. Okay. As earlier I said, right, the inventory turnover can be used using the cost of goods sold or the sales. In this case, we only have the sales, so it's pretty obvious that this is what we should do. But it would be normally industry specific, which one we would want to use. Capital asset turnover is my sales, 4 million, that I divide by my capital asset, $500,000 in this case. Here we go. And then my total assets turnover is simply my sales. I'm missing a 0, I think, that I divide by my total asset, and that's my answer. I won't compute all of these for you. You're free to use your calculator to compute these if you want to. Also, there is here a second question that just changed in the next year. The sales change. Okay. Account receivable, so on and so forth, also change. Calculate the ratio again, so I'll let you do that one. It is in the book. You can verify it in the book if you need to. Is the change in account receivable, inventory, capital asset turnover good? Remember, all of these turnover ratios are better if they're higher up. Again, it depends, right? It depends if it marks an increase in like if it means we turn it over faster because we have increase in how efficiently we use our resources, or if because our credit policy is too stringent, or if we have inventory stuck out all the time. So obviously it depends. There could be a way where this could be negative if they're going too high because of those kind of mistakes. but by and large it's a good sign if all these ones go up. The only one we prefer to be down is the account payable turnover. So I'm not going to calculate all of these again. It's the same way as what we did before. And the last question here is pretty straightforward. Again, a lot of students prefer to just use the equations that are given in the equation sheet. I don't know how many of you want to do the CPA. I don't know how many of you want to do the CFA. I have my CFA. You're not going to make it through if you just try to remember equations by heart. Okay, there's no way you're going to make it through. You want to learn to think about these things logically. It's going to make your hundreds of equations much easier to remember, and this is how I get through all these questions. This is how I got through my CFA too, right? Okay, if I want to solve this question, here is the way I would solve it without using the equation in the notes. We know that the credit sales, right, our account receivable turnover is 12 times. Okay, so every year, right, our sales divided by our receivable gives us 12. Okay, so 12 times our receivable will give us our sales. Makes sense for everyone? Okay, we want to, and this is not just all sales, this is credit sales, right? We want to know on average, right, what are our credit sales on average in a day. Well, we have our sales for the year, and we know there's 365 days in the year. So once we know this, we can just take our sales and divide them by 365, and we're going to get the answer. Right? Super straightforward. Don't need to know the equation by heart. Just use logic. Again, and if you follow the logic and the arguments I gave you, you just need to know the account receivable turnover equation, and then everything just makes sense from there. Okay. Obviously, here I could be making a mistake if the financial statements was quarterly, but it's not specified. I'm pretty sure they're using yearly financial statements, and in the real world it'd be easy to verify what's the length of your financial statements. So it wouldn't really be an issue here. Okay, so I'll just do that. I think I already calculated it. No, I didn't. So I have 12 times 90,000. This was my sales. Is that good? Okay, let's pretend that's good. And then I divide this by 365, and then I get my my average credit sales per day, $2,959 roughly. Okay, roughly, approximately equals to that. Don't do that in the quiz, by the way. I would expect 2,958.90 in the quiz. So just don't do that for the quiz, but here it goes for that. Okay. So other types of ratios, we have liquidity ratios, which are ratios that measure, right, how much we're able to pay our short-term liability. Okay. So they're all basically using current liability as the denominator. Okay, and then they use different measure of current asset or short-term assets as the numerator. Okay, so we have the current ratio, which is just current assets divided by current liabilities. Okay, we have the quick ratio, which is my current asset minus my inventory divided by my current liabilities. Yes, so these ratios, again, it's preferable that they're higher, but at the same time you should know that if I invest too much in cash, for example, which would make these ratio higher, it will lead to worse performance because cash has a really low rate of return, right? So this is preferable to a certain extent if it's higher. Sorry, but again, as usual, it could be also too high. The debt utilization ratio, they're often called leverage ratio. Okay, and they highlight the ability of the firm, while liquidity ratio is solvency, short-term liquidity issue, that it highlights. The debt utilization ratio highlight the ability to meet our financial obligation, our debt payments in the long term. Okay, there's a bunch of 3 different ones that we're going to talk about here. The debt to total asset ratio, which is just total debt to total asset. Okay, we actually talked about this previously, in a question. It was in there. The times interest earned. Okay, it's our income before interest and taxes. Okay, so our EBIT divided by interest. And the fixed charge coverage ratio, the income before fixed charge and taxes divided by the fixed charge. Okay, again, all of these, if they are higher, right? Sorry here. The debt to total asset ratio is probably better if it's lower, right? I mean, there's no like right or wrong answer here, but from the point of view of a lender, they would prefer the debt to total asset ratio to be lower and these last two to be higher. Okay, from the point of view of a lender, as someone who invests in the firm, as we saw earlier, if the debt to total asset ratio is higher, it will increase the ROA and thus it will increase the ROE, right? So there's a lot of interaction between these ratios, but from a lender's point of view, we would want this one to be lower, and we would want these two here, the last two, to be higher. Okay. And then there's a couple of questions, but I'm about at the 20-minute mark, so I think it's a good time to stop. And I think I have like another video basically to do for you. So, okay, I'll stop here.